Okay, welcome everybody. This is my first attempt at a YouTube video. I don't know how it's gonna work out, but I think it'll work out okay. Bear with that. I think the hardest part is gonna be for me to get used to, one, talking into the camera, and two, figuring out how to post the videos. Okay, so what I want to do now is yesterday, or not, sorry, not yesterday, but last week, I had assigned chapter 17 that was related to tax losses. Okay, so before we get into talking about tax losses, now remember, if we go back to chapter 16, we figured out how to determine what our tax payable was. Okay, now we started off with our accounting income, and we had to convert that to a taxable income. Okay, so let's now fast forward to chapter 17 where we're dealing with the tax loss. So the most important thing when we're looking at a tax loss, okay, and again, we are following the tax payable method. It's for small business, okay, basically non-publicly traded companies. Now, if we are a small business, we can use the tax asset liability method. I just don't do it. The reason for that is this is a simplified version, and it's enough for us to get by. This is what all small businesses use. So let's get to the basics. Okay, not the basics, but if we have taxable income, okay. Now hold on a second here. I got to get my brush. If we have taxable income, so we knew from past classes. Let's just say our tax rates, we're going to use 10% because that's a realistic rate for small biz. Okay, so let's just say we had $100,000 of taxable income times 10%. We know that we're going to have to cut a check to the federal government for $10,000. Okay, so again, that's the basics of it. Okay, now, if we make money every year, all we do is take our taxable income times the tax rate, and we remit that amount. So you remember that from chapter 16, debit, income, tax expense, credit, income, tax payable. Again, for the 10,000. Now, I rigged up this whiteboard on my own. It's a piece of plexiglass that I found in the garbage. So it's not the clearest. I have another idea that I'm going to do to get things a little bit more clear, but for now we're just going to have to make do. Okay, so that's chapter 16 right there in a nutshell, right? What happens though if we have a loss? A lot of companies will benefit from this by buying other companies and able to use their tax loss. So I thought about something before, okay? Now the most important thing that we got to know about tax losses, okay, is that we can carry the tax loss back 3 years, or we can carry it forward 20 years, okay? So let's just look at a few scenarios, okay? So let's just say in year 2011, we lost $20,000. Okay, it happens, first year business. Then what? Well, now in 2012, we made 30,000. Okay, so if you didn't know any better, what you would do is say, okay, well in 2011, tax rate's 10%, 10% times negative 20, well, you're not paying tax on a loss, okay? So that'll be zero. So tax payable is $0. Okay, now in 2012, we made $30,000 profit. I'm just taking my hat off. You can see my hair was getting quite long, so I just shaved it off yesterday. Anyways, so 2012 comes along, we make $30,000. Okay, now again, if you didn't know any better here, you'd say, okay, $30,000 times 10%, we owe $3,000 in tax. But that's not how you do it, okay? You gotta remember, when you have a corporate tax loss, you're allowed to carry that loss back 3 years or carry it forward 20 years. So what we wanna do is, we don't wanna have to pay tax if we don't have to, okay? So we had a $20,000 loss in 2011, made $30,000 in 2012. So what we're going to do is we're going to carry back our loss. Okay, sorry. We're going to take we have our loss carry forward or carry back. Okay, so since we made $30,000 in 2012, okay, we're going to go back. We're going to carry forward that loss. Okay, so what's that going to do is our taxable income is we're going to use up this loss. So we're only going to have to pay tax on $10,000. Okay, so our net income, yes, was $30,000, but we're going to use our $20,000 tax loss from 2011. As a result, we're only going to pay tax of $1,000. How $1,000? Well, $30,000 minus the $20,000 tax loss from the prior year, okay, gives us $10,000 that we have to pay tax on. So that's how you kind of get that benefit there. Now for 2013, say we made $50,000, okay, we don't have any tax losses to use up from prior years, okay, so we'll just pay our 10% and we'll pay $5,000 tax. Okay. Now, let's just say that something happens in 2014 and we lost $40,000. Okay. Not only do we not have to pay tax for 2014, we also get a refund because we can carry this tax loss back 3 years. So we can carry it back to here, we can carry it back to here, and we can carry it back to here. Okay, but you got to remember, there's nothing to carry back to 2011 or 2012. Why? Because we used up the loss. Okay, we lost 20,000 in 2011. We made in 2012 we made 30,000. Okay, so as a result, we don't want to have to pay more tax than we have to. So what happens there? We used up our tax loss. So the only thing that we can apply this $40,000 loss to is the 2013 year. So again, what's going to happen there? We're going to use up our tax loss carry forward, or sorry, our carry back, okay, because we can carry it forward or we can carry it back. So as a result, we're going to get back a refund, okay? So the $40,000 loss times 10% is going to get us a refund this year of $4,000, okay? Now, the 2014 loss is all used up. 2015 comes along. Now you got to remember, we have computer software, so at the same time we can do this. Our software is going to track our losses forward. We're just going to do it automatically. But let's just say in 2015 we lose another $50,000. Well, we can't get a refund because there's nothing to we've used up all our losses. So now we can carry this forward 20 years. Okay, so we would just say 2016, we would chip away at it. Let's just say in 2016 we made $10,000. Okay, we're going to carry some of the loss forward to the 2016 year. We're going to pay zero tax. We're not going to get a refund because there's no refund to get because we've gotten back all the money we've paid in tax already. So 2017, how much are we carrying forward? We're carrying forward a loss now of $40,000 into 2017. Okay, so maybe in 2017 we make another $20,000 net income. Well, there's still no tax to be paid. Why? Because we're using up the remaining $40,000 tax loss carry forward. Again, 2015 we started with a net loss of $50,000. In 2016 we made 10, but we're not paying tax on the 10 because we're using up the loss of 50. So that left us with 40,000 of a loss carry forward going into 2017. Okay, 2017 we made 20,000. We're going to shelter that. So now it's down to $20,000 at the beginning of 2018. Okay. So with 2018, again, maybe we finally turned things around and we made net income of $100,000. Okay. So 2018, we make $100,000 of net income. We don't want to pay 100,000 times 10%. Why? Because we have a $20,000 loss carry forward that we can use. So 100,000 times minus the 20,000, we're only going to be paying tax on $80,000 times 10%, which is going to give us $8,000, if you can see that, of tax payable. So now we fully used up all our tax losses from that 50. Now again, we're starting over for 2019. Okay, so you're always just going back and forth, back and forth. You know, it can be a tricky concept, but it is what it is. So what I would like us to do is look at an example that they use in the textbook. Okay. Now, what I don't like about the textbook is sometimes it's not reality. Okay. If these sometimes they give an example where the tax rate's changing every year. It doesn't change every year. Okay. It just doesn't. It's for small business, it's been stuck at 10.5% for years. Okay. So if we go to an example, one of the examples that I gave you was, let's go to TR 17.7. Okay. Now again, what I don't like about that question, it was jumping around. Okay. Again, the tax rates were always changing. But it is what it is. So actually, no. I'd first off like us to go to TR 17.2. Okay, I'm just going to stop it for a minute and erase the whiteboard.